All right, this evening, as sort of a review of what we're going to be talking about in class over the next couple of days, we'll be discussing the New Deal. And specifically, we'll talk about why the supporters of the New Deal felt that the government needed to regulate industry and labor. We'll also talk about the New Deal programs that provided jobs. And finally, we'll try and answer the question as to whether or not the New Deal was successful or not. All right, first New Deal. Now, it's, to be uh, precise, the New Deal doesn't start until Roosevelt becomes president. Franklin Delano Roosevelt is who we're talking about. A little background on the architect of the New Deal. He suffered from polio. He had contracted it when he was in his 20s. By the time he was in government, he was um, in a wheelchair. He was the Assistant Secretary of the Navy during World War One, and was a governor and a Democrat of the great state of New York. As governor during the Depression, he cut taxes for farmers, and he distributed $25 million in aid to poor New York families. So this was a successful program that Roosevelt implemented in the state of New York. And as you can see, or probably tell, the New Deal is going to be an even larger scale aid program for families who are in need. He easily defeated Hoover in the 1932 election, and in January of 1933, he took over, and he inherited a country with the highest unemployment rate ever in our history, 25%. Basically, one-fourth of the whole working population could not find employment. That's as it's defined in your economics textbook. So Roosevelt, when he was running for president, and of course when he became president, he talked about the New Deal, and the New Deal is relief and recovery for the United States of America. Uh, it's also just really the government's attempt to do anything to help the economy. The first thing that they did was they shut the banks down. They do this to prevent any more runs being put on the banks. And we talked about in class last week that banks had doled out deposits that belonged to other people and put it in the stock market. So when the stock market crashed, the banks lost money that other people thought would still be there. This is one of the things that they will take care of with the Securities and Exchange Commission. It regulates the stock market and it prevents market fraud. And it does just that. It makes it illegal for you to purchase stock with borrowed money. If you're going to buy stock from now on, it's going to be your money. It's not going to be somebody else's money that you're borrowing, or a loan from a bank or anything like that. Now, when you borrow money from a bank and you invest in the stock market, you could make the value of the stock that you just bought go up. And that's what we call an inflated price. It's also what the SEC refers to as market fraud. If too many people buy into the same stock with borrowed money, then the stock has an inflated value. It's not really worth that because it's being bought with money that's not there. All right. That brings us to our next point, the Glass-Steagall Act. It separates commercial banking from investment banking. And you guys being teenagers, you might not really understand um, the difference between investment and commercial banking. I'll make it very simple for you. A commercial bank is like Wachovia, or I guess it's now Wells Fargo, um, Bank of America, places like that. They're going to handle deposits, checkings, and savings accounts. That's that's the bulk of their business. They may have a few business accounts here and there, but for the most part, they're going to be dealing with just deposits and savings. An investment bank would be like Prudential or AIG or ING, um, or like Liberty Mutual, or things like that. I'm trying to think of TV commercials that you maybe have seen. Those banks only deal with the investment side of banking, meaning they're going to work with Roth IRAs and 401ks and things that you've heard me talk about in class all the time. That's what they do. They take that money and they invest it. But even then, it's an investment bank that you're not borrowing money to invest. That's not how uh, investment banking works anymore. There's no such thing as speculation. That way, if anything ever did happen, you wouldn't have people's deposits uh, robbed from them because the bank was uh, dipping into two different markets, the investment market and the commercial market. The Glass-Steagall Act also implemented the Federal Depository Insurance Commission, and that protects the deposits, meaning if somebody robs a bank and there's no money left in that bank, your account is still there. It's your money is still there. It's federally insured. The government will come in and make sure that your account is reimbursed. Okay. Before the Glass-Steagall Act, the FDIC was not around, which meant that when people lost their uh, savings from the banks through no fault of their own, except for the fact that they were depositing money into the banks, uh, it wasn't there. Once the stock market crashed, it was gone. People lost their life savings. With the FDIC in place, that won't happen anymore. Roosevelt also is big with helping the farmers. This is one of two uh, uh, aid deals for the American farmer. This one's known as the Agricultural Adjustment Act. It stopped farm surpluses and made prices go up. Farmers will also receive $1 billion in aid. Now, Roosevelt also forms the National Industrial Recovery Act, and this lets government, business, and labor uh, to set up voluntary rules for each industry. The rules were going to be called the Codes of Fair Competition, and it's the government interfering in business, basically. The government setting prices, minimum wage, they're shortening work hours, they're allowing unions. If you've seen what's been going on with unions in Wisconsin, Ohio, and other states, when the economy is bad, that's the time period where it always seems like unions are stepping up saying they need more of this or they need more of that. Well, the government also forms the National Recovery Administration. It's the agency that enforces the codes of fair competition. So basically what you've done is you're regulating industry, but at the same time, as you can see, you're increasing the size and scope of the federal government. The federal government at one time was not really into labor. They let business take care of itself. Now they're not doing it. And it is declared unconstitutional in 1935 by the Supreme Court. And when you think about it, the government, although you have to believe at the time period they thought they were doing the right thing, higher wages means higher prices for products. Because businesses aren't just going to say, oh, well, people are struggling, we're going to pay them more, even though we're selling less. If you do that, you won't be in business very long. If you think about it, you can't make a $3 pizza and sell it for $1. You'll go out of business. The higher wages that the government forces companies to pay, that cost is not going to be put on the business. That's going to be put to the consumer. So the products that these people are making are actually going to be more expensive. Why? Because now they have to pay their workers higher wages. So to cover the costs, the expenditures get put on the consumer. All right. And the other thing that you have to think about, and certainly it was outlined in the Supreme Court decision, is that setting price, when the government sets prices, they are limiting competition. You want consumers to figure out which product they want to buy and which product they don't want to buy. You don't want to set prices because competition tells us somebody's going to lower the price. The prices won't stay high forever unless people are just buying them like crazy. The prices will go down if the consumer is patient. The last point that the Supreme Court makes is when you force the higher wages, when you force uh, uh, the stipulations of the Code of Fair Competition puts on American businesses, it doesn't leave enough money around for companies to expand. The whole point of capitalism is to come up with a product that everybody's going to want, and you find a cheaper, more productive way of making it so that you can sell more of it at an affordable price. That's what capitalism is. In this case, Roosevelt and the government get involved. Most economists today that have studied the Depression will tell you that the government actually extended the Depression. Had they just left things alone, the economy typically can fix itself. You know, the consumer market can actually fix itself. All right, the Homeowners Loan Corporation is signed, and they're going to buy mortgages from people who are behind in their payments. This is similar to refinancing. It's not really a success because only 10% of the nation can get it, and you're only going to make loans to people that are still employed. People that aren't employed, they're going to be out of the house. And the loan corporation still foreclosed on 100,000 plus homes. The Farm Credit Administration is formed. Again, when you see the word administration, it's government. These are government jobs that they're making. They loan money to farmers. Let me get back to that. They loan money to farmers, particularly to try and even things out. They paid farmers not to grow certain crops. For example, if there was too much corn on the market, the price of corn went down. So I'm going to pay you, you know, farmer in Iowa, to not grow corn. Amazing. All right. There are other projects that you can see here. And we're going to hire people to work in the forestry service. That's 3 million jobs. We're going to fund the Public Works Administration, which people are going to build construction projects that are probably needed. Dams, bridges, highways, sewer systems, schools. All that stuff's probably needed. The Civil Works Administration is going to employ 4 million people. And then in 1934, they end up firing 4 million people. So they're hiring and they're firing. If you look on this page alone, they hired 7 million. Then within a year, they fired 4 million. The simple fact is that the government cannot grow big enough and create enough jobs for the private sector. In fact, most people would argue that that's not why the government exists. The government exists to garner a free market where businesses can compete. The government cannot create jobs. The thing about government jobs are paid on taxes. If everybody works for the government, how are they going to get their money? They're going to pay themselves. It doesn't make a lot of sense. So these are the New Deal projects, and as you've seen, the Supreme Court knocked a few of them down. So it's up to you to decide whether or not it was a success or not. When we come back tomorrow, we'll talk about the second New Deal. All right, do your homework, stay on top of things. See ya.